Most people pick between a Roth IRA and a traditional IRA like they are choosing a sandwich. Turkey or ham, mustard or mayo. But this decision can quietly shape how much control you have over your taxes in retirement. Pick wrong, and Uncle Sam may become your most expensive retirement roommate. Let me show you the simple way to think about it. If you are building wealth in your 20s, 30s, 40s, 50s, or beyond, this choice is not just about saving for retirement. It is about deciding when you want to pay taxes, how much flexibility you want later, and whether future you is sipping coffee on a beach or arguing with a tax form at 73. Quick note, for a deeper dive related to wealth generation, get my book, The Wealth Basics, a practical guide to investing and building generational wealth, the stuff we should have learned in high school. Available on Amazon. Link is in the description. Let's get started. Here's the plan. I will show you what each account does. I will show you the tax math in plain English. Then I will give you a simple decision framework so you can stop staring at retirement account options like they are written in ancient pirate code. Disclaimer: this content is for educational and entertainment purposes only, and is not financial, legal, or tax advice. Investing involves risk, including loss of principal. Consider your goals, time horizon, and risk tolerance before investing. Speak with a certified financial advisor to help you develop a customized plan. Now let's get back to learning. Think of the traditional IRA as the tax break now account. If you qualify for a deduction, you may lower your taxable income today, your money grows tax deferred, and later, withdrawals are generally taxed as ordinary income. Think of the Roth IRA as the tax freedom later account. You contribute money you already paid taxes on, the account can grow tax-free, and qualified withdrawals in retirement can be tax-free. Translation: future you may open the account and say, "Wait, that is it? No tax bill?" Beautiful. For 2026, the IRS says your total combined contributions to all traditional and Roth IRAs generally cannot exceed $7,500 or $8,600 if you are age 50 or older. Combined means combined. You do not get to max both like retirement savings are a buffet with 2 plates. But here is where most people get this wrong. They ask, which account is better? That is the wrong question. The better question is, when do I want to pay taxes? Now or later? Scenario 1. You are in a lower tax bracket today and expect to be in a higher tax bracket later. The Roth IRA may be attractive because you pay taxes now while your rate may be lower. Then aim for tax-free qualified withdrawals later. This can be especially powerful for younger investors, early career earners, or anyone expecting income to rise. Scenario 2. You are in a higher tax bracket today and expect to be in a lower tax bracket in retirement. A deductible traditional IRA may help because it can reduce taxable income now, then you pay taxes later when your rate may be lower. That is like telling taxes, "Not today, tiny gremlin. We will talk when I have more time and possibly better knees." Scenario 3. You want flexibility in retirement. Roth IRAs do not require required minimum distributions during the original owner's lifetime, while traditional IRAs generally do require minimum distributions starting at age 73. That matters because forced withdrawals can affect taxes, Medicare premiums, and how much control you have over retirement income. Here is a simple mental model. Traditional IRA. Save taxes today, pay later. Roth IRA. Pay taxes today, potentially save later. Neither is automatically better. It is like choosing between coffee now or coffee later. The right answer depends on how sleepy you are, how much coffee costs, and whether future coffee is controlled by Congress. Now, here's the part nobody talks about. The best retirement strategy is not always Roth or traditional. Sometimes the real flex is having both. because tax diversification gives you options when life, tax laws, and your retirement plans decide to do jazz hands. Use this quick decision framework. Choose Roth if you expect your future tax rate to be higher, you want tax-free qualified withdrawals, you value flexibility, or you like the idea of no required minimum distributions during your lifetime. Choose traditional if you need the tax deduction now, you expect to be in a lower tax bracket in retirement, or you are trying to reduce current taxable income. Just remember, not every traditional IRA contribution is deductible if your income is too high and you or your spouse is covered by a workplace retirement plan. And consider using both if you want options. Fidelity and Vanguard both frame this decision around current versus future tax treatment, eligibility, income limits, withdrawal rules, and retirement flexibility. In plain English, build tax buckets so future you can choose where to pull money from instead of being cornered by one giant taxable bucket wearing a villain cape. Quick recap. Roth IRA means pay taxes now and aim for tax-free qualified withdrawals later. Traditional IRA means potentially deduct now and pay taxes later. The 2026 IRA contribution limit is generally $7,500, or $8,600 if you are 50 or older, across Roth and traditional IRAs combined. The right choice depends on your tax rate today, your expected tax rate in retirement, your income eligibility, and how much flexibility you want later. If you find this video helpful, make sure to like, share, subscribe, and hit the notification bell to help the channel grow and reach more investors who want to build smarter, calmer portfolios. Do you want a deeper dive into how to use AI to generate wealth? Get access to checklists, templates, real examples, ready-to-use AI prompts, and free AI agents from the Second Act Investor AI Advisory System. Grab your copy of AI Meets Finance, Investing in the Age of Artificial Intelligence, available on Amazon. Link is in the description. Continue your investment learning journey by selecting the Investing 101 playlist, where we break down retirement accounts, investing basics, and wealth building without making your brain file a complaint with HR. Thanks for watching, and I'll see you in the next one.